The following was recorded in front of a live studio audience at the Studio 21 Podcast Cafe. This is the United Podcast Network.
Welcome to Easy Money New England.
Oh, can somebody help us here?
We can, because we are real estate and mortgage professionals.
Where you go? It says come in and browse.
That's right. Come on in, listen up, and learn.
How long do you intend to browse?
In a short period of time, our panel will teach you some tricks that might make your house buying easier.
You don't ask her how long she intends to browse.
You might not be looking for a mortgage today, but we'll get you ready.
You don't look like browsers.
Are you looking?
Oh, what do browsers look like?
Yeah, maybe I'm half browse.
On his father's side.
This is Easy Money New England
Let's show the lady we're browse.
with your host, Brian DAmico.
Hey, look at us, we're browse. One more word out of you and he gets it, all right? Come on.
Welcome to another edition of our show, Easy Money New England, where every week we bring you money-making opportunities or money-saving tips all around the areas of real estate. But this week we switch it up a little bit. I mean, we all think that real estate is the best investment class out there. I mean, real estate, it's tangible, you can see it, you can touch it. But today's guest, we want to talk about a different asset class, which is precious metals. And our guest today, his name is Peter Hugg. He's the director of global trade for Kitco's Metal, Inc. Peter has been involved in the precious metals industry since 1974. He speaks to thousands of viewers each week on Kitco News, drawing on years of frontline experience to provide a trader's perspective on the market. Mr. Hugg contributes daily commentary and market insights for the millions of readers visiting Kitco.com each month. A frequent speaker at precious metals conferences and in the financial media, Peter is also He's one of a handful of experts who have succeeded through multiple bull and bear cycles. Prior to joining Kitco, Mr. Hugg served as Senior Vice President at Guardian Trust Company, now a part of Laurentian Bank, which became one of the largest international trading houses for precious metals. Mr. Hugg also has developed the first precious metals certificate program and used in the first margin trading accounts for metals on the cash market. So today he's calling from, I believe, Palm Springs. So Mr. Hugg, Peter Hugg, welcome to our show.
Pleasure to be here.
So Peter, I mean, let's get right down to it. I mean, really, when people think about investments, they think about real estate, they think about stocks, they think about bonds, they think about mutual funds. Very rarely do I hear people say, "Oh, well, I'm buying gold or I'm buying silver." Can you talk about what people think about when they go into the precious metals market?
Well, having been in this industry since 1974, I cut my teeth in the foreign exchange business and then got into the metals business in '78, and was fortunate enough to be involved in the metals market when the first spike in the metals occurred in 1980, with gold going up to $850 and silver at $50. And over the past 40 odd years, it's been when clients ask me, should they buy gold? It really I tried to analyze it over the past 3 years. I've noticed that the questions that I get today are very similar to the questions that I got back in the late 70s, and the criteria for people's motivation to buy metals has not changed in those 40 years. And so what I did was I tried to look at the sort of the psychology of why somebody wants to buy gold. And, gold isn't an end all. Sometimes gold is an excellent investment. Sometimes it's not so good of an investment. It really depends on your timing and what your motivation is to get into the market. But when I looked at the investor profiles of people that were engaged in the gold market, I was able to break it down into basically 4 groups. And those 4 groups have been relatively similar ever since gold first started trading freely in '73. The first group I call and again, it's difficult to put a name tag on this group, but sort of call them the end of worlders. They're influenced by analysts that think the financial system is going to collapse, that we're going to have hyperinflation, that you can't trust the government, that you need to hold your gold literally under your mattress because you can't trust it to be stored with any third party. And these individuals are influenced by, for lack of a better word, the doomsdayers that think, with the end of the financial world coming, you need gold as a barter system, and gold is going to go to $10,000, $20,000, $30,000 an ounce. That group sounds, from a fringe perspective, sounds a little fringe, but it really does contribute to a large offtake in the physical market. And their motivation is to buy small units of gold, not the most inexpensive method to buy gold. So they buy 1 ounce and below in size varieties, because they honestly believe that they're going to need this gold barter system when the financial system collapses. So they're not
almost like a doomsday prepper.
Yeah, and they're not that concerned about price. It doesn't matter to them whether they pay $1,200 or $1,500. They're holding this for in essence the apocalypse, and so they want to hold this gold, and they always almost take the gold delivered to their homes. They very rarely store it in allocated storage accounts. They do not trade ETFs. They do not trade mutual funds. They have a total distrust of the system.
Right. So I thought about buying gold previously, and I always thought to myself, well, where am I going to keep it? Is it gold bars? Is it something? How do you store gold?
Well, again, it's to buy physical gold, you really need to have a distrust for the system, because there are much more efficient methods for investing in gold. Again, if you go through the groups, I mean, if your concept of buying gold is because you want to trade gold the same way you would trade Apple stock, or you might be buying real estate, your primary motivation, I would suspect, is capital gain.
Right.
And if that is your motivation, buying physical gold in small units, like 1 ounce bars or below, where the premiums on these units are anywhere from $30 to $50 over the price of gold, from a trading perspective, a capital gains perspective, you're adding 3 to 4% to the cost of your investment before you break even. There are much more efficient methods if you want to have gold in your portfolio that track closer to the actual value of the market, i.e. ETFs, or you could buy mutual funds, or you can buy larger bars in gold if you're financially capable, where the premium price to the actual price of gold on the spot market is relatively close, so that your exit maneuver is for a realization of capital gains is closer to the market than waiting for a 3 or 4% recapture of the premium before you're at a break even.
So that sounds like a myth, that when people buy gold, they're buying bullions and they're buying gold bars, and they're keeping it in their safe at their home or under their bed. I mean, so you really, to buy gold, it's not like that. You don't have to actually store it yourself.
No, you don't. But if you do want to store it, store gold, you have basically two options. One option is that most dealers offer delivery. Most dealers offer free delivery, so you can have gold delivered to your home. That creates an issue of insurance, creates an issue of storage. It really depends on how comfortable you are with having that gold in your home. You'd have to insure it separately. It wouldn't be covered under your general homeowner's policy. The second way, which also gives you more liquidity, is to store the gold in what's called an allocated account, where the gold is off the balance sheet of the dealer and held in your name in a segregated account. And then the advantage to that is that if you ever want to liquidate your gold, you can liquidate it immediately. You don't need to ship it to the dealer before you can sell your gold. So that gives you some liquidity. And storage costs on gold are relatively incidental. You're talking anywhere, depending on the amount that you want to store, anywhere from 1/4 to 1/2% per annum. So it's not cost prohibitive from the perspective of having somebody else store your gold.
All right. So if someone's listening to this podcast right now, and they always say, well, I'm thinking about it. Why should I consider buying gold?
Again, it's the motivation. So if you're not a trader that's trading in and out of the market, which again is relatively difficult for the retail investor, there's not a lot of instruments that allow you to do that. But if you wanted gold as an insurance position, and you know, that's sort of been the dogma of the gold analysts ever since gold started trading freely, that you should hold a percentage of your gold, a percentage of your portfolio in gold. You know whether that's 3%, 5%, 10%. It really depends on the you know, the economic conditions at the time. But they never finished the sentence. You know, it's one thing to say that you should hold 5 or 10% of your assets in gold, but it should be treated the same way you would treat the balance of your portfolio, which means you should reconfigure that portfolio or at least look at it every 6 months. So let's assume that you're holding 10% of your assets in gold to protect the other 90% that you may have in the equity markets or in real estate, and you just want it in case 2008 happens again. But what you need to do is you need to recalibrate that portfolio. So just to give you some like basic math examples, let's assume you bought gold in 2008 at $800 an ounce.
Yep.
In 2011, gold got to $1,900, a little higher, but around $1,900 for round numbers.
Right.
Everything else being equal, I would suspect that when you analyzed your gold portfolio, that 10% allotment that you bought in 2008 was probably now worth 17% of your portfolio because of the rise in the gold price. In that context, if your aim is to hold an insurance position of 10%, you would have needed to sell 7% of your holdings. Vice versa, if you had gotten in 2011 at $1,900 and then in 2015 gold hit $1,050, your holdings were probably no longer 10%, but maybe 6%. So you needed to buy 4%. When you do that, you keep the insurance policy, but you tend to lighten up on your gold holdings as the price moves higher, and you'll add to your gold holdings as the price moves lower, but always maintaining that 10% portion of your portfolio.
Very interesting. And what's the difference between gold and silver, say?
Well, silver's got more of an industrial component attached to it, so it has a bit more of a reliance on the economic vagaries in the market. So if you've got a strong economy, silver demand in things like the solar industry will pick up. So you'll have an industrial component to silver, which is not that apparent in gold. What silver does do, if you look at charts ever since it started trading freely with gold back in '73, when gold is in a bull market and moving higher, silver will outperform on a percentage basis. But it will also perform on a percentage basis when the market reverses and goes lower.
Okay. And
so they call it a sister metal to gold, but I mean, if you're looking for volatility and you're looking for a bigger percentage play, silver's a better metal to play that with, whereas gold is more a metal that is more consistent with what's going on in economic terms.
Right. Is that why they? What's junk silver? Is that?
Well, junk silver is just pre-1965 U.S. quarters, 50-cent pieces, dimes, dollars had silver content in them. And there was a term that was phrased back in the early 80s. Dealers used to collect these dimes, quarters, and make them into bags, $1,000 face value bags. And each bag, $1,000 face value bag of pre-1965 coinage, had the equivalent of 715 ounces of silver in it. And they called this investment junk silver bags.
Gotcha. That's interesting. So Peter, you know, if I'm listening to the show right now, you know, how do you buy gold or how do you buy silver? I know it's not your typical, you know, you call up your financial advisor, say, I want to buy silver or I want to buy gold. You know, how do you go about that?
Just a matter of going on the internet and just saying, you know, just type in the keywords buy gold, buy silver, and you'll get a variety of dealers that'll pop up. You go to the dealer websites, you determine which product you want to buy, whether you want to buy a silver eagle or whether you want to buy silver bars, and they list their pricing. And you can then go to other dealers and compare that pricing. And basically, it's as simple as booking the transaction over the telephone. You send in your money. Upon receipt of the money, they will ship you the bars and or store the bars in an account for you. It's an extremely simple transaction.
So how do they know they're getting a fair price? I mean, do they just compare it on their own to the website, or is there someone that helps them kind of understand if they're getting a fair price or not?
Well, again, when you see the price, when you go into the financial papers and you see the price for gold or silver quoted to you, if you go on CNBC and you see the bottom line where they stream the gold and silver prices, platinum, palladium as well, that's what is basically the wholesale market, and it's what's priced for what is called a standard bar. Now, a standard bar in gold is a 400-ounce gold bar. So if you've ever watched the James Bond movie Goldfinger, it weighs about 40 pounds. And the standard size bar for silver is a 1,000-ounce bar. Now, any bar size below that, and gold goes anywhere from 1 gram, which is a 32nd of an ounce, all the way up to a 400-ounce bar. Silver goes anywhere from 1 ounce. Sometimes you can get fractional ounces below 1 ounce, but generally 1 ounce up to 1,000 ounces. Rule of thumb, the smaller the bar, the more expensive the premium relative to the actual price. So to give you an example, if gold today was trading at, just for round numbers to make it easy, $1,200, if you bought a 400-ounce gold bar, you would be able to buy that very close to $1,200 an ounce. If you bought a 1-ounce gold bar, you would pay a premium anywhere between $10 to $25 over the gold price for the 1-ounce bar. And that reflects the premium and the fabrication cost to make that smaller unit.
Interesting. So does it, what is the bid price versus the ask price? I mean, that's very similar to a stock as well, right?
Exactly right. And that's called the spread. And again, it's between dealers. So you can go to one dealer and you might see that on a 1-ounce gold bar, they're paying you a premium to spot. When I use the word spot, that means the actual price for a 1,000-ounce silver bar. Or they may pay a discount, a small discount. It really depends on the dealer's inventory and the supply-demand equation. But it's really easy to shop it. There are sites that you can actually go for comparison pricing, and you'll put in 1-ounce Silver Eagle, and they'll pop up 5 dealers, and it'll show you which of the 5 dealers at that moment in time is quoting the best price on Silver Eagles. So it's very easy to get a comparison and then be able to make an informed decision as to who you think the best dealer is.
Yes. So recently I've watched an infomercial, and they talk about buying gold, and I would never feel comfortable on an infomercial buying gold. How do you know that gold it's real, it's not fake? I don't know if you saw that infomercial, but it just didn't seem real to me.
The one that says we're going to sell it to you at our cost?
Yeah, I think that's the one. It looks like it's from the government, but it just doesn't seem right that the government would be doing an infomercial. No,
they wouldn't be. And, again, it is buyer beware. So I can give you a couple of hints. One, if you call that company and ask them for we can sell you a 1-ounce, we can sell you a gold American Eagle at cost, and I think the price was something crazy like $110. It sounds really cool, but when you go in there, it's not a 1-ounce Eagle that they're selling. It's a 1/10 of an ounce of an Eagle that they're selling, gotcha. which is the smallest coin. And when you go in, they tend to say, we can sell you one at that, but if you want to buy more, here's the additional cost. And then they try to sell you other things. Sometimes they try to sell you semi-numismatic coins where the premiums are 40, 50, 60% over the intrinsic value of the metal. And that's where they make their money. I'm not suggesting that this infomercial company does that, but that's how you would check it out. Most companies and I don't want to use the word reputable, but most companies offer a product which is called, and they all have their different brand names for it. We at Kitco call ours Mint First. And that is product that is guaranteed by Kitco that comes directly from the mint. Whether we buy Maple Leafs or from the Royal Canadian Mint or Eagles from the U.S. Mint, these coins have never been in circulation. We seal them, and they are basically as if you bought them directly from source. So those coins carry a slightly higher premium, but you know that they are from source. Other coins that dealers buy back from the public. It really depends on the dealer's testing protocols. We have extremely aggressive testing protocols, and we list those coins as circulated coins, which means, in essence, like a used car. They've been previously owned, but the company that sells the coin stands behind the product, and it goes to the reputation of the dealer. I mean, we've been around since '79. I'd be a little hesitant to be doing a large transaction with a dealer that just popped up and they opened up their shop 6 months ago. Not that there's necessarily anything wrong, but I'd be a little bit more careful there as opposed to working with a dealer that's been in the business at least 5 or 10 years.
So if that gold was in circulation, is it almost like buying a used car versus a new car? Is it different value, or is it the same because it's the same weight?
We make the value of the intrinsic value of the coin or the bar is worth exactly the same as a bar or a coin that comes directly from the mint, but it might have a scratch on it. It's just not a new product that's come directly from the mint, but it is absolutely has the same value as a non-circulated coin. But clients sometimes want something that has not been circulated, and so a lot of the dealers, not a lot, but there's 3 or 4 dealers, including Kitco, that offer product that's directly from source.
So that gets into really the quality of the product, right? So can you talk a little bit about, what's the best quality products when you're looking to buy gold, silver, platinum, or palladium?
Well, I mean, I don't know if I want to use the word quality when I'm answering your question. What I look for when I buy an investment is I buy something that is as close as possible to the actual cash price of gold or silver, the actual 400 ounce or 1,000 ounce standard price for gold or silver. But the second criteria that I use before I buy something is I want to have liquidity, and I want to have liquidity not only in my local market but possibly in other markets. And I'm now a U.S. resident, so I've got to wave the flag a little bit. But Americans tend to buy American gold eagles, and because they're made by the U.S. Mint and they're a good coin. I'm not saying there's anything wrong with the coin. But it's not a pure coin. It's like the South African Krugerrand. It's a 22-karat gold coin. And in the U.S., the liquidity for that coin is extremely good. So no issue at all. But if you were to take that coin to Hong Kong, for example, or to Canada, you will not get the same premium when you sell it that you would for something like the gold maple leaf or the gold buffalo, because that's a 4/9 gold coin. And American eagles in Canada, because they are 22 karat, are taxable. The Chinese have no interest in gold eagles because they're 22 karat. The Chinese want 24 karat gold coins. So if you're buying a coin and you're going to sell it locally in the U.S., then a gold eagle is as good as any other coin. If you're buying a coin, but you might want to someday sell it in Canada or in Europe or in the Far East, I would recommend you go with the Canadian maple leaf or with U.S. buffalo, which are both 4/9 gold coins, as opposed to buying a 22 karat coin, the American eagle.
So is that 4/9 versus like a 999 grade, or?
Well, an American eagle is 22 karat, and a gold buffalo, which the U.S. Mint came out when they realized that the eagle was a 22 karat coin. Came up with the gold buffalo, which is 4/9, and the maple leaf is 4/9. So that's a 24 karat. That's as pure as a gold coin can be made. Gold bars are the same. They're 4/9 gold bars, and whether you buy a 1 ounce bar made from the Royal Canadian Mint or a 1 ounce gold bar made from the Perth Mint or from Johnson Matthey or some of the other internationally recognized refineries, you're getting pure gold and in a 1 ounce wafer. And wafers or gold bars tend to be cheaper than coins because it's less expensive to produce them. For example, a U.S. 1 ounce gold eagle, the premium on that coin to the dealer that's direct from the U.S. Mint is approximately 3%. So at current gold market, that's roughly about $39 premium. Now the dealer has to add on his profits. So a gold eagle will sell at about $50 over gold price. Whereas a 1 ounce gold bar, exact same amount of gold, you can get for as little as $10 over the gold price. So you're paying an additional $40 for the American Eagle for the coin, but you're getting the exact same amount of gold as you would in a 1 ounce gold wafer.
Very interesting. So everyone wants to talk today. They want to talk about, Bitcoin and not gold coin, right? So, I mean, everyone keeps telling me Bitcoin, and I've been watching it for a few weeks, and I'm like, geez, this is something that What's your take on Bitcoin versus gold?
God, I can't. I just can't put my mind around it. I mean, my kids are smarter than I am. My son bought Bitcoin when it was down to $2,000 for a Bitcoin, and so he's pretty happy. I usually don't invest in something I don't understand, and I don't understand Bitcoin.
I don't know.
And what concerned me about it was that it wasn't regulated, and it was the volatility in the product is extreme. I mean, yesterday or over the last 2 days, it went up 3,000. Just overnight, it dropped $1,800. Now it's back up again. I think what I'm interested to see is on Sunday night at 6 o'clock when the CME, which is the futures market, opens, they're going to be offering futures contracts on Bitcoin. So to date, all you've been able to do if you wanted to be involved in Bitcoin is to buy it. And hope to God that you didn't buy at the top, and so far everybody that's bought is happy. But as of Sunday night, you're going to be able to short that market on the futures contract. So it's going to be interesting coming into Monday to see what that does to the actual value of Bitcoin. And I would suspect it's either going to be up or down $5,000 on Monday, just because now you've got people that can short the product, which has not been available to other investors. So it's going to be an interesting open on Sunday night at 6 o'clock, and then it'll be interesting to see how that flows into New York on Monday.
Well, today, just to timestamp this, today's December 8th, and we'll in December 11th, we're going to see kind of what happens to Bitcoin when the futures market will be trading this. It's going to be very interesting for sure.
Yeah,
any predictions, Peter?
Well, it's going to add a lot of liquidity. I mean, there's a lot of people out there that think that this is a bubble that should be at zero. So I would suspect there's going to be a few of the players out there that are going to try to short this market. But if they're unsuccessful, if you short the market, it's not like you can go and cover it. It's not like a hard commodity where you can buy it somewhere else. So if they're wrong when they try to short it and then they have to scramble to cover it, the moves can be extreme. So flip a coin on which way it's going to go on Monday, but I expect Monday to be an extremely volatile day in Bitcoin.
Very interesting. Yeah, another question for you. I mean, we drive around here, we see big billboards, cash for gold. Bring in all your jewelry, and there's been like Tupperware parties. Now there's gold parties.
Yep.
What's been the increase on everyone doing cash for gold and making a little bit of extra money and I believe they just melt the stuff down?
Yeah, they do. I mean, I don't think the volumes in that business are that great right now. They were extremely heavy when gold moved up into, excuse me, over $1,500 in 2011. It was it was a lot of volume going through. Right now, there is some selling, but again, at $1,200, there's not as much volume as occurred in 2011. You need to be careful. Because a lot of these cash for gold places are totally legitimate. I'm not suggesting they're not, but if you really analyze what they're paying, they could be as much as 30 or 40% below the actual metal content of your jewelry.
Yep.
They never pay you for your stones, so I would remove your stones. If you're selling jewelry, you get zero credit for any diamonds or rubies or anything else that are in your jewelry. So remove the stones, and then have the gold weighed. And Kitco provides at kitco.com. We have a scrap converter. So if you have 14 karat gold, 18 karat gold, or 22 karat gold, it'll tell you what the value is, actual value, gold value in that piece based on weight. So you'd have to weigh it. You'd have to convert your weight probably to grams, and then multiply it out by either the 14, 18, or 22 karat matrix on the scrap page that we have, and that'll tell you what the actual value is. So let's assume you have a bracelet that has enough weight that should be worth $800 of actual gold if it was melted. Then you can determine when somebody gives you a bid whether it's reasonable to the gold market or whether they're taking a huge discount. And there are numerous places that you can sell scrap jewelry. I don't mean to call it scrap jewelry, but the gold content of your jewelry. And you should be getting no less than an 8% discount to the actual intrinsic value of your gold jewelry.
That's very interesting, especially, we're around the holiday season. People might be, it's a good time for them to kind of trade in some gold to liquidate if they're not wearing it and they're not using it. I mean, I know that a lot of thieves, they're going right after the small jewelry in your house, right? And that's probably what they're doing. They're just going and get cash for gold.
Yeah. But again, you can shop this as well, the same way you can shop a 1 ounce gold eagle if you're looking to sell it. But if anybody's paying you more than an 8% discount, again, if you're desperate and you've got, again, depends how much you have. If you have a ring that, with the total gold content worth $400 and somebody pays you $320, it's really up to you whether you want to go and shop it around to see if you can pick up an extra $30 or $40 for it. But you just, again, be advised that some of these cash for gold places, they'll take anywhere up to 40. I've seen them take as much as 50% off the intrinsic value of the metal.
Yeah, no, that's good information. So we have our engineer here, Ed. Ed, do you have any questions for Peter?
I do. I've been following closely because that's part of my job. But I think what I heard you say earlier is that gold as an investment, it's important to understand what your strategy is at buy time and understand how it fits into a balanced portfolio. So if I decide at this point, I don't know, let's say I have $1 million and you were throwing out 10% as a number. If I decide to buy that, I go on. I know you mentioned that at some point I would go to some place on the internet and say, okay, I want to buy that. At the time I do that, click the buy button, is that the price I'm getting or at the time that you actually receive payment for it?
It depends on the dealer. If dealers have certain parameters on how much they're prepared to quote you without a deposit. So if you wanted to do $100,000 worth of gold,
right,
we would require a small deposit before you could lock in the price. Up to $50,000, we would take just your credit card, and not that we're going to put the transaction through on your credit card, but a credit card in case you decided to cancel the transaction, because then we would either have to, let's assume you bought gold at $1,200 and you gave us a credit card to hold the price until you sent in the money for the $50,000. And then for some reason you changed your mind and the gold price was now at $11.90. That $10 loss is basically on the client's side, so the credit card basically protects the dealer from the client reneging on the deal.
Got it.
But almost all dealers will lock in a price for you over the phone, so you don't have to wait till the money comes in before you can lock in your price.
Interesting. And yeah, I've been studying Bitcoin myself.
Yeah, we're not doing a Bitcoin show for sure.
No, but like everyone else, I waited till the price was high to figure out what's going on with it. But it seems to me that it's all about perceived value. And do you think that's true with gold as well? There's just an agreed upon perceived value for what it's worth?
Well, if you based it on the fundamentals, if you based it on what does it take to take an ounce of gold out of the ground, I still think the production cost on gold is somewhere on average in around the $900 an ounce level. So now it's trading at $1,200. Now, is that 30% premium justified? I think it is. I think the equity markets personally look to be ahead of themselves. We have geopolitical risk with North Korea. We have, a financial system that, in my opinion, has mended, but I don't think is going full guns. And I'm not sure the economy is as strong as the Republicans want us to believe it is. And so now you have a situation with the tax cuts that's going to add another $1 trillion to the deficit. You've got the Fed that is wanting to raise interest rates, but if they keep raising interest rates, the debt financing is going to explode. So there's a number of factors out here that make the financial system somewhat shaky. I'm not saying.
And when it's shaky, people tend to invest in things like gold. They tend to invest in things like bonds, right? I mean, is that the real driver of uncertainty or political risk and everything you just mentioned? People that's the safe investment.
Well, that has been the historical mode. People have moved into gold, but and even though I'm a gold dealer, but again, I'm going to be 66, so this is sort of behind me as opposed to in front of me. Yeah. What is changing is my parents' generation. Again, hopefully not for everybody that's listening, but it's certainly my parents. Yeah. They're not around anymore. And, so they've lived, and my parents' generation lived through World War I. They lived through the Great Depression. They lived through World War II. They've seen what happens to the financial system when you get those kind of disruptions. My generation, we never really saw it. There were a few wars, one just as I was born, and then the Vietnam War. But again, no real major financial shakeups. I have to discount the dot-com bubble in 2000 because that was a ridiculous bubble. It was obvious. But 2008 was really the only financial crisis that my generation has seen.
Which was pretty severe. I mean, it was very severe. So, I mean, what happened around that time? People were investing a lot into gold at that time? I mean, is that what drove up the price?
Yeah, you saw gold go from $600 to $1,900. It almost tripled through that financial mess that began in 2008. Now, so we're still. My generation is still somewhat cognizant of the risks, but again, I'm 66. And I mean, I may live another 10 or 15 years, but somewhere down the road,
you could do better than that, Peter.
Well, you know what I mean.
Yeah, right.
My orientation is going to be to preserve capital, so I'm still going to be inclined to have a portion of my assets allocated to something like gold. Right. But what about my kids? They haven't seen any of this. I mean, the 2008, my kids were basically still in their early 20s. They didn't experience any of these shocks. So the question is the next generation going to be as enamored with gold, or are they going to be more enamored with the cryptocurrency type of investment? And are they going to be worried about the financial collapse and thereby buy physical gold, or are they going to be totally happy buying ETFs and mutual funds and investing in gold mining shares? So that demographic shift is beginning to occur. It's still got, in my opinion, about 10 years to run, but after that, the whole dynamics of why you would invest in physical gold may change. Right now, I think there's still a viable argument to be made to hold a percentage of your portfolio in gold.
That's very interesting. I mean, because it truly is. It trades just like a stock would, right? It's supply and demand. The more people get in, the more the value is going to rise.
Yeah, it does. And, sometimes gold's a great investment. Sometimes it's a lousy investment. But, it's the same as, look at GE. And look at, there's times when you want to be in the stock and times you want to be out of it. And if this economy really starts to click and the Republicans got this right and the Fed does start raising rates on a more continuous basis in 2018, I would suspect, assuming no geopolitical risks and North Korea doesn't, nothing happens there and nothing happens in the Middle East, which is also starting to boil over, that the trend for gold will likely be lower in 2018. But I don't believe that the Republicans have got this right, and I don't believe that the Federal Reserve is going to be tightening rates aggressively in 2018. I don't think they can afford to. which means that the stimulus that the central banks, both in the U.S. and in Europe and Japan, have been engaged in for the past 5 to 7 years is going to continue. And I think that is price positive for the metals, because I do believe somewhere down the road it will trigger inflation. And that's the missing ingredient here to get gold moving.
That's very interesting. So I'm listening right now, and if you could talk a little bit about Kitco.com. I checked out the site, looked very interesting. It seemed like I could make a transaction right from Kitco.com. And one of the things you brought up, I mean, you can't buy gold on credit card, can you, or is that just a deposit?
No, you can. There's dealers that allow you to buy up to a certain amount. I think it's usually capped at around $7,500 or $10,000, but you can buy on a credit card. Again, I would advise, if you do that you pay your credit card off, because otherwise you're financing your gold purchase at 19% per annum.
All right. But at least you get some. At least you get some travel miles.
Well, you do. Okay, fair enough. But for convenience purposes, to buy it on your credit card and then pay it off at the end of the month buys you 30 days carry on your money, which is not a bad thing. Hang on, sorry.
Yeah, no problem.
Gives you 30 days carry on your money, and then you pay it off. But if you don't pay it off, you're carrying your investment at 18%.
Right. So that wouldn't make sense just to get the miles for sure. So if we want to get started today, we go to Kitco.com. Is there any tutorial? Do you just go right to the site? You kind of look at, do some research, and Kitco is a dealer, right? You can buy directly through them.
Yeah, you can buy from Kitco. And again, I don't want to give a plug to Kitco here, but I want to, having been in this business since '74, I consider Kitco extremely unique, and I'll tell you why. When you go to the other dealers, I mean, basically they're selling product, and they're doing their promos, and everything is flashy and cool, and nothing wrong with that. But Kitco.com, there's a Chinese wall there. Our media division, if you read the articles that are posted on Kitco.com, I mean, technically, we're a gold dealer. It would be in our interest to sit there and say the world is coming to an end and buy gold. But if you read the commentaries, there are as many commentaries on Kitco.com that suggest the price may go lower, just as there are as many saying that the price is going to go higher. And they're all by independent analysts. They have no affiliation to Kitco. And they basically write what they believe the market is going to do. So from an educational perspective, Kitco.com is one of the most viewed sites in the world for people that are trying to gather information and trying to make an informed decision. Once you've made your decision, then you obviously have the option of buying from Kitco or buying from any other dealer. But as far as getting information, I haven't found a site better than Kitco.com for just the new investor or even the seasoned investor getting up-to-date information on the precious metals market.
Very interesting. I mean, that's I'm definitely going to check that out again too, and I think that all my listeners actually will too. And Peter, I just want to thank you for the time that we had today. That was very eye-opening. The knowledge in this market is surpassed by anyone I've ever met. So I just want to thank you for coming on, and thanks again.
Oh, it was a pleasure. Thank you. Thank you for having me.
All right.
The views and
So, closing on our show this week, I mean, I think we learned a lot from Peter Hug, and we always like to say here, there's no such thing as easy money. And if you do have any money making opportunities, give us an email, info@newfed.com. Again, this is Brian DAmico, Easy Money, New England. Thank you very much. Hi folks, it's Brian DAmico, owner of New Fed Mortgage, and I'm really excited to introduce Fast Track Mortgage, our new online system that gets you approved in less than 15 minutes. Whether it's a refinance or a new purchase, just go to newfed.com anytime, day or night, and click on the Fast Track Mortgage button. Fill out the form, and within 15 minutes, we'll approve your loan at the lowest rate possible. Don't waste time dealing with big banks. We're local and here to help you close your loan fast. Just go to newfed.com 24/7 and get approved in less than 15 minutes. Fast Track from New Fed Mortgage. Now that's a new way to get the loan you need fast.
877 New Fed.
Subject to credit approval, Equal Housing Lender, NMLS number 1881. Call us website for details.
877 New Fed 1.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21 Podcast Cafe, the United Podcast Network, its partners, or affiliates.